This is how financial crises are manufactured. Most people believe financial crises are accidents, random events, unexpected shocks that no one could have predicted. But when you zoom out far enough, a very different picture appears. Crises are rarely sudden. They are built slowly, step by step, through incentives, policies, and decisions that seem reasonable in isolation, but dangerous when combined. In other words, many financial crises are not born overnight. They are manufactured over time. Before we go deeper, if you value calm, system-level analysis instead of loud headlines and panic narratives, take a moment to like this video and subscribe. It helps channels like the Silver Collapse Report keep breaking down what's actually happening beneath the surface. Let's start with an uncomfortable truth. The modern financial system is not designed to eliminate risk. It's designed to manage it, and often to hide it. Risk doesn't disappear. It moves. It shifts from visible places to less visible ones. And when it concentrates enough, it eventually demands attention. This process usually begins with policy. After every crisis, authorities promise stability. They lower interest rates, they inject liquidity, they encourage lending and spending to restart growth. In the short term, this works. Markets recover, confidence returns, politicians take credit, and the public moves on. But these solutions come with side effects. Low interest rates make borrowing cheap. Cheap borrowing encourages debt. Debt fuels asset prices, stocks, real estate, bonds. Rising asset prices create the illusion of wealth, and that illusion justifies even more borrowing. Over time, the system becomes addicted to easy money. At first, this looks like success. Economic growth appears steady. Markets rise, volatility disappears, risk feels low, but stability itself becomes the danger, because prolonged calm changes behavior. Investors take more risk to maintain returns. Institutions increase leverage. Standards quietly weaken. This is how fragility forms. One of the most powerful tools in this process is liquidity. Liquidity sounds harmless, even positive. It simply means money flowing smoothly through the system. But excessive liquidity distorts decision-making. It rewards speculation. It reduces the cost of mistakes. And it allows inefficient structures to survive longer than they should. Eventually, the system forgets what true risk feels like. Another key ingredient in manufactured crises is moral hazard. When markets believe central banks will always intervene, behavior changes. Losses are softened, mistakes are rescued, and success becomes less about sound decisions and more about positioning close to the source of money. Over time, risk becomes asymmetric. Profits are privatized, losses are socialized. This encourages leverage at every level. Hedge funds borrow, corporations borrow, governments borrow. Debt stops being a tool and becomes a requirement. The system needs constant expansion to stay stable, but no system can expand forever. As debt grows, sensitivity increases. Small changes in interest rates matter more. Small slowdowns in growth become dangerous. The margin for error shrinks. And once the margin is gone, stress begins to show, quietly at first. This is where crisis manufacturing enters its second phase, signaling. Markets begin sending subtle warnings. Yield curves invert, credit spreads widen, certain sectors underperform. Liquidity concentrates in fewer hands. None of this looks dramatic individually. Together, they form a pattern. But here's the problem. Acknowledging these signals would mean admitting fragility, and fragility threatens confidence. So instead of correction, the response is often more intervention, more liquidity, more assurances, more narrative control. This delays the reckoning, but increases its eventual cost. Crises are also manufactured through complexity. Financial products become more advanced. Derivatives multiply. Risk is packaged, sliced, and redistributed. On paper, this looks like diversification. In reality, it often creates hidden concentration. When stress arrives, these complex structures don't absorb shock. They transmit it. This is why many crises appear to spread suddenly. In reality, the connections were always there. They just weren't tested. Another overlooked factor is time mismatch. Financial institutions borrow short-term and invest long-term. This works as long as confidence remains high. But when trust wavers, funding disappears instantly while obligations remain. This mismatch turns uncertainty into panic. Again, this isn't accidental. It's structural. Central banks understand these risks, but they also face political and economic pressure. Tighten too early, and markets react violently. Wait too long, and imbalances grow. Every decision trades short-term stability for long-term fragility. This is why manufactured crises often feel inevitable in hindsight. Now let's talk about the human element. Narratives play a crucial role. Stories like soft landings, strong fundamentals, and temporary inflation keep confidence intact. They don't have to be lies. They just have to delay doubt. People want to believe systems are under control. Investors want reassurance. Politicians want calm. And media wants simple explanations. Together, these forces smooth the surface while pressure builds underneath. By the time narratives change, reality has already shifted. This is also where asset markets come into focus. Stocks often continue rising late into the cycle, not because conditions are improving, but because liquidity is still flowing. This creates confusion. People assume rising prices mean reduced risk. In reality, they can indicate growing dependence on support. Precious metals behave differently. Gold and silver don't rely on earnings or promises. They reflect confidence, or the erosion of it. When trust in policy weakens, when currencies lose credibility, when real interest rates fall, metals often begin moving before broader markets react. But in the modern system, even this signal can be distorted. Paper markets, futures contracts, and leverage can suppress or delay price discovery. Physical demand and structural stress don't always show up immediately in prices. This creates a dangerous disconnect. It allows policymakers to believe the system is stable until physical realities force recognition. Manufactured crises usually end the same way. A trigger appears. It could be a bank failure, a currency shock, a policy mistake, a geopolitical escalation. The trigger gets blamed, but the trigger is never the cause. It's the match, not the fuel. The fuel has been accumulating for years. When the crisis finally becomes visible, responses are swift and dramatic. Emergency programs, liquidity injections, guarantees. These actions may stop the immediate collapse, but they also reinforce the cycle. Each rescue makes the next crisis larger. This is the paradox of modern finance. Stability today often means instability tomorrow. Avoiding pain now increases pain later. Understanding this doesn't require predicting exact dates or events. It requires recognizing incentives, watching behavior, observing where stress is being pushed instead of resolved. At the Silver Collapse Report, this is the lens we use. We don't ask, what will happen tomorrow? And we ask, what is being encouraged, suppressed, or ignored right now? Because systems move in the direction of incentives. As we continue this series, we'll examine where current incentives are leading. In currencies, central banking, precious metals, and market structure. Not to spread fear, but to restore clarity. Crises feel random only to those who look at the surface. To those who watch systems, they follow a script. Stay calm, stay analytical. And remember, when a financial crisis finally looks obvious, it's usually already been manufactured.